So last time we get this call from Gary in Georgia. He wanted to know about what's next for Carvana. That's a digital-first used car retailer. Just given the stock's had a huge run this year. I told him I believe in Carvana, not necessarily as a short-term trading vehicle, but as a long-term investment, because I believe in the leadership of CEO Ernie Garcia, who's created a tremendous amount of value over the years, been on the show a couple of times. I enjoy the way he thinks. Tonight, I want to dig deeper. You need to know how to evaluate an incredible stock that's pretty much doubled in the past 3 months. Of course, Carvana tends to be a real wild trader, but it's been on an amazing upswing for the past couple of years. I started pounding the table on it back again in mid-2023 when the stock was in the 40s, and now it's at 345 and change. But to Gary and George's point, Carvana's been particularly strong over the past few months. The last time I gave a big push for Carvana was in early April, right after Liberation Day, when we were struggling to find something, anything to recommend to you in that hideous tape. Stock was at 181 at the time. It plunged all the way to 148 within the next few days. I told you this was a very straightforward story. President Trump was talking about slapping extra tariffs on imported cars, and I figured that would make Carvana's used cars a lot more competitive. Since then, the stock's up 90%, and it's up 133% if you caught it at the April lows. While Carvana is still not quite back to where it peaked in 2021 at $376, it's within spitting distance of those levels, and I think it's only a matter of time before it starts making new all-time highs yet again. So, yeah, the stock's been red hot, and I'm sure there are plenty of people like Gary who did the responsible thing and sold it into strength on the way up, but are now wondering if they got out too soon. All right, that's why I want to dig into this move and think about where Carvana's headed over the long haul. The stock went into overdrive May 7th after the company reported a totally blowout quarter, with record retail unit sales up 46%, revenue up 38%, and earnings coming in at $1.51 per share. Wall Street was only looking for 73 cents. I mean, come on. They more than doubled what the analysts were collectively expecting. Carvana doesn't give much in the way of explicit forward guidance, saying only that they expect, quote, a sequential increase in both retail units sold and adjusted EBITDA in the second quarter, end quote, which means they expect to hit new quarterly records for those metrics yet again. At the same time, management rolled out some new long-term financial targets. They want to sell 3 million retail units per year at an adjusted EBITDA margin of 13.5%. 3 million, 13.5% within the next 5 to 10 years. Now, to put that in perspective, last year Carvana sold a little more than 416,000 vehicles, EBITDA margin of 10.1%. So we're talking about a huge jump in volume and a major uptick in profitability if they can deliver. Maybe they can. Basically, after 8 years where management had some clear goals that were mostly focused on growth, with some acknowledgement of the need for profitability, Carvana's now got a new set of priorities, more focused on long-term unit growth and higher margins. I think they're very much on the right track here. That makes it even more exciting for me. Finally, in its letter to shareholders, which, by the way, is a great read, management gave a quick reminder about the scale of the opportunity. I always talk about scale. Listen to this. Quote, the automotive retail market is enormous, with U.S. consumers purchasing 40 million used vehicles and 16 million new vehicles per year. We believe we are in the very early stages of addressing our opportunity and have a very clear path towards our goals of becoming the largest and most profitable automotive retailer and buying and selling millions of cars per year. End quote. That would work for me. Later on, Carvana punctuates their point, saying, quote, this quarter we sold nearly 134,000 cars and generated just shy of $500 million of adjusted EBITDA, and we did this with just 1% of the overall market, end quote. Now, that's important. As much as Carvana's grown over the years, from $859 million in sales in 2017 to almost $14 billion last year, isn't it incredible? They only control just 1% of this extremely fragmented auto sales market. Given that these guys have come up with an incredibly convenient way to sell used cars, I bet they've got a lot more room to take market share. Now, ever since the company reported in May, the stock's been a juggernaut, even though there hasn't been much company-specific news, aside from a whole lot of analyst support. At the same time, I think Carvana's riding a couple of other waves. This company's perceived as a big winner as Wall Street became convinced that we're looking at a couple of rate cuts from the Fed by the end of the year. Most people need financing to buy a car, and lower rates would sure make it cheaper to borrow, which means more sales for Carvana. What else? Carvana's long been beloved by the younger individual investors who increasingly seem to dominate parts of this market, especially in the last few weeks. These people love going after overextended short sellers, so it doesn't hurt that more than 8% of Carvana's float, meaning the shares that they've traded freely, have been sold short. And you know that game. That's the old GameStop game. Plus, remember why I recommended the stock in April, and it wasn't about busting shorts. That's not the way we play it here. As President Trump slaps more tariffs on foreign cars, Carvana's used vehicles start to look a lot more enticing. When the White House announced these new 25% tariffs on auto imports from South Korea and Japan, well, that was very good news for this company. Now, could the stock pull back here? Of course. It's had a huge run, currently approaching overbought territory. You know how I feel about that. Meanwhile, I don't like the recent tick higher in longer-term interest rates. And if that continues in the wake of one big, beautiful bill act, well, let me just say that would hurt Carvana. Because, again, most people need to borrow money to buy even a used car, and that's priced off the treasuries. It's also worth noting that the father of the CEO, Ernie Garcia II, also a co-founder of Carvana, has sold a lot of stock recently, $270 million worth since late May. That's only a fraction of his total holdings, but in the past, his sales have often marked near-term tops for the stock, including the middle of last year. But insiders sell for many reasons. Historically, Carvana always bounces back. People have told me to short the stock off of that guy's insider selling over endlessly. It's just, no. I mean, it's not a way to be able to try to make money. You got to have fundamental reasons to short. Here's the bottom line. I like Carvana for the long haul because I'm a true believer. But that doesn't mean that stock will charge endlessly higher without taking some detours. In fact, I hope it gives you a big pullback because that will let you get back into the stock at a very nice discount. Never forget, Carvana's built a best-in-class business model, and management's on track to deliver both strong growth and rising profitability. If you don't own already, you do have my blessing to put on a small position here. Then you got to wait for the opportunity to buy some more on weakness only. Mad Money's back after the break.
Coming up, can this IPO climb to the top of the summit? Cramer's digging into media ad company Mountain and seeing if the stock can reach new heights. Next. Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.